Hello, good afternoon. My name is Manesh Samtani. I'm the editor for Regulation Asia. So first off, welcome to today's program of events, and thank you to all of you who also joined us yesterday. Before we start this panel, I'd just like to quickly encourage everybody to try to, throughout the afternoon, use this events platform to network with your peers, visit some of the sponsors' booths, engage in the chat boxes throughout the afternoon. I know this might be a bit new to a lot of people, including myself, but who knows how many more events we'll be forced to hold online rather than face-to-face. I'm sure we're all looking forward to getting back to the face-to-face events. So yes, please do explore the platform and do feel free to send us your feedback afterwards to sort of help us improve over time. So without further ado, welcome to our first panel of the day. Enhancing transaction monitoring with data and analytics. So we often hear that one of the biggest pain points at banks is the large amounts of false positives generated by traditional rule-based transaction monitoring systems. So often it's a highly manual process that's required to identify which alerts require further due diligence and investigation. In this session, we're going to discuss how transaction monitoring systems can be enhanced and made more effective with the help of new technologies, data, and analytics. So joining us today on our panel of experts, first we have Lee Ashmore, Global Head of Anti-Money Laundering Technology at HSBC. Lee also serves as Regional Head of Financial Crime Risk IT for Asia Pacific. And I know he's constantly working to enhance HSBC's AML systems and controls through collaboration with technology guys, with regulators, and so on. Welcome, Lee.
Happy to be here.
Happy to have you here as well. And I believe Richard Carrick is about to join us. Richard is CEO at Crime Stoppers International Asia. He has extensive banking experience, most recently with Barclays, where he was responsible for ensuring the bank's Asian businesses were compliant with FCA as well as local regulatory requirements across Asia, and obviously trying to protect the bank from criminal activities. Let's see if Richard can get connected in a second. Finally, we have Douglas Wolfson, Director of Commercial Strategy, Financial Crime Compliance at LexisNexis Risk Solutions. So with almost 2 decades of experience in financial services, risk management, and international business, Douglas drives strategy and product development of tools used by some of the world's big banks to mitigate financial crime risks. There you are, Douglas. Welcome. Thank you for joining us.
Thank you very much. Sorry about that. Minor technical difficulties, but we're back.
No problem. We'll see Richard connect in a moment as well, hopefully. Before we kick off, I'd just like to remind all of our attendees to feel free to submit questions for us throughout the discussion. We'll try to get to them. I know there's a lot to cover. If we don't get to anything, then feel free to engage with us by chat or email. So yeah, I'd like to sort of maybe ask Lee to help us kick off the discussion. I understand transaction monitoring is very close to your heart, Lee. So I thought maybe you could start off by talking about some of your experience using some of these rules-based transaction monitoring systems, some of the challenges you've encountered, and perhaps your approach in tackling some of these issues with the false positives that we always hear about. Go ahead, Lee.
Within HSBC, obviously, we do use rules-based transaction monitoring systems. Now, rules-based TM is what most banks in the industry use, and the problem with it is that it's a bit of a blunt force instrument. So it generates huge numbers of false positives. I think the industry standard is around 95% false positives on rules-based TM, which can often lead to quite a large number of people who they spend the vast majority of their time sifting through. I guess we can only call it garbage. So, and that's for banks like us, that carries a huge amount of cost and human capital as a result of that. So, we are investing heavily in terms of looking into the use of AI and analytics to be able to reduce that burden on our staff. We're looking at ways that we can use AI and data analytics for sifting through the garbage, so to speak, identifying where the real risk is, maybe providing some contextual scoring around the events that are generated, so that we can make sure that the investigators spend most of their time on the more productive alerts. We're also looking into, ways that we can use AI and data analytics to improve the way that we monitor both pre-detection and post-detection, to be able to see if there's a way that we can identify a risk that maybe traditional rules-based TM systems aren't currently tackling.
I don't know if Douglas or Richard, do you have anything to add to that? You're both probably very familiar with these sort of systems.
Yeah, I would say, I completely agree with everything that Richard has said. Lee has said. And I'm sure I will agree with everything that Richard says. What we find in speaking to clients around the region is very simply that when they use the rules-based transaction monitoring rather than actually monitoring for risk, as Lee mentioned, 95% false positives is a morass of validation and essentially wasted work, because it's all transactions that you want to allow to happen. They're transactions that your financial institution is getting paid, but you have to do the investigation, on all of them. And so you end up losing a lot of time. And so, we end up talking a lot with clients about things like data analytics, machine learning, artificial intelligence, to find ways to, look through that data, to reduce the false positives, and to monitor transactions and risk monitor, rather than threshold monitor. If you have a rule where you have to monitor every transaction that you have to review every transaction that occurs over $5,000, for instance, it's just a threshold. There could be people transacting over $5,000 all the time. It doesn't mean that it's risky business. It's really looking for the riskier transactions in that giant pile of hay, looking for that needle in that giant pile of hay and trying to reduce the size of the pile of hay.
Yeah, exactly. I think the other thing that's sort of missing there is you have a bit of a problem with the bank only being able to look at transactions only. If you kind of just look at transactions only, they're on their own, they're going to look fairly innocuous most of the time. It's actually seeing how they fit into a wider pattern of transactions. And I think in order to be able to see if there's anything wrong with those, you really need to look at contextual data behind it. So going beyond the transaction data, you need to be looking at things like, how are they connected? How is the person sending connected to the person who's receiving, for instance? And what else do you know about them? Is there adverse news media about them? It's being able to kind of put all of that together into one picture that then kind of provides the context that lets you know if something is wrong. But on its own, transactions are going to look fairly, it's very difficult to see from transaction data only.
Yeah, that's really interesting.
I think, Richard, you raise a very good point. I'm just going to say, Manesh, not to pitch another session that you're not involved in, but this evening I'm talking with Nick about digital identity, and I think Richard raises a really good point, which is if you have someone who makes a cash deposit into a branch, and then that deposit is transferred to another bank or to another location or whatever it might be, that may be risky, may not be risky on the surface. But if you then look at someone deposits cash in one location, say Hong Kong, and then the person who logs in, the digital identity who actually makes the transaction, is really sitting in Australia, then you start to wonder, wait, how did that person deposit cash in Hong Kong, but then get on a computer in Australia and make a transaction from there to another account? And it's, as Richard says, it's about looking at more than just the transactions themselves. It's about looking at attributes involved of the people, the transaction, everything.
Yeah, just while we're on this, before we get too far ahead, while we're on this topic of false positives, I just kind of want to get a sense from the audience of how big an issue this is. A very simple poll. We can put it up right now. There's a button on the platform that says polls at the top right. So if the audience, if you can go ahead and click on that, what is the level of impact of false positive cases to your compliance process? So very simple, high, neutral, or low. and we'll just revisit that in a minute once the responses come through. So while we wait for that, just quickly, one thing I did want to understand is about, I suppose the traditional rules-based transaction monitoring systems. How difficult it is to sort of make changes to them. Say, for example, if a regulator, let's say hypothetically, Australia changes the threshold from 10,000 to 15,000. What is the process for implementing these changes? Is it the same across most of the banks these days? Is it something that an outside vendor needs to come in and do? Is there something that can be handled outside? I don't know if you have different opinions on this. Lee, what's your perspective?
I can speak for all the other banks, but certainly within HSBC, we tend to do this in-house, and resegmenting customers, retuning thresholds is a long and complex process. It can be quite clunky. So, this is where AI and data analytics has a potential really good use case to be able to speed this up and maybe provide more dynamic tuning and segmentation of customers. That would be great. I mean, particularly if we look at the impact of COVID-19 in the world so far this year, nobody saw this coming, right? So you've seen customer transaction behavior change almost overnight in many countries around the world, and therefore the threshold settings in systems are they're massively impacted, right? I'm not going to say they're useless, they're not, but behavior has changed as a result. So this is something that we're starting to look at in a great deal more detail right now, because this has presented severe challenges to companies like ourselves, and maybe Douglas and Richard are able to shed more light in terms of the wider industry.
Yeah, I can throw a little bit on that. I used to previously be with Barclays Bank as the regional head of financial crime assurance. So I've done, a lot of reviews on various transaction systems and the processes around them. But as far as what I understand is generally within the industry, most of the tools usually require a bit of hard coding. There's amount of scenario modification that you can do, but there's certain areas that need to be customized, and you have to go out to the company and have that coded if you don't have in-house experts who can actually code that. But it's also a lengthy process because it has to go through the bank's permissioning processes. So you have to then get there has to be an updated sort of scenario policy or threshold policy, including the new changes. It's got to be signed off by a senior MLRO for a region or a global, and then it goes out and then get put in. But the big problem is if you're a criminal, you just change your methods and what you're going to do kind of on the spot within a few minutes. Whereas by the time the banks put it in, if it's urgent, it might take a few weeks, a month. But if it's not urgent, it'll just simply go into the next kind of annual refresh. So that's sort of the difficulties that arise there. And
it's something we were just previously discussing, is that when something is rules-based and you tell everybody what the rules are, you're also telling the criminals. And so the ability to change behavior is significantly quicker within criminal organizations than it is within large organizations that require to have change operations. There is a process by which you have to make sure that when you change things, that you don't create issues down the road for other systems, for other parts of the organization. And, I think what we see from an industry perspective is that very large organizations like HSBC will handle that internally. They manage their own systems internally. Obviously, a large part of Lee's role, I'm sure, is managing a lot of those processes and change processes. Smaller organizations that we work with, we end up working on the rules, tweaking the rules with them, and making sure that they understand what the changes are going to bring, and helping them with putting those changes in place. But I think, when you talk about themselves, it's really almost an unknown unknown. I mean, at best, a known unknown, in that you don't know what changing a threshold, changing a rule, what that's going to create on the back end. When the regulator says, oh, you should do X instead of Y, they think it's a good idea, but they don't know what the result is going to be. It could result in a 100-fold increase in false positives. It could result in a reduction in false positive and an actual increase in finding real risk. Both are possible, but it's really, unless they're strongly tested beforehand, just changing rules can bring unknown consequences.
Thanks. That's really interesting. Helps me to understand a bit better. I just want to go back to the poll results. So what is the level of impact false positive cases have on your compliance process? 87% say high, 8% say neutral, 5% say low. I'd like to have, some of the people who selected low on the next panel we do and see what they're doing differently. But in any case, I don't know if you have any responses to that. It seems probably what you might have been expecting.
Yeah, I was sort of expecting that.
Definitely.
Yeah, I think it is. Yeah, but I guess the beauty of the rules-based TM systems is that it's quite easy to be able to explain the scenario logic and the thresholds to the regulators. When you're using machine learning AI, that becomes much more difficult because, there are cases where models have been written that even the guys who wrote the models don't really understand how a decision was made in terms of whether activity was risky or not. And that's the challenge now. There's a lot of emphasis in terms of explainable models so that we can get regulators comfortable.
Well, that's actually my next question. I wanted to see if we could have you guys speak a bit about the AI and machine learning in transaction monitoring systems. I suppose as far as I've been told, they could. I don't know if the AI and machine learning is at some institutions might be built straight into the transaction monitoring systems, or in other institutions it might be implemented as a layer on top. I don't know if you could talk a bit about your views on that and your experience in that, but then also to building on that, kind of explain how it's reducing costs, boosting efficiency, enhancing effectiveness. But whoever wants to go first, go ahead.
I don't think it is actually increasing efficiency so much at the moment. You just have to look at the way in which AI is kind of currently being used. AI, what they tend to do now is take a look at false positives that pop up several times in a row, and then it learns that is a false positive, and then it'll suppress it. But at the same point in time, it's not helping you get true hits, because as Lee had mentioned before, if you have a bunch of garbage that's coming out, it doesn't matter how you massage the garbage. At the end of the day, you might have reduced it, but you're still stuck with garbage. So you're not really finding anything useful at that point. So I think that's I guess the limitation. Probably the better win in this is probably just around data analytics itself, by adding the contextual information that we mentioned before to reduce the false positives that way.
A couple excellent points there in that, I still think that a lot of, when you hear machine learning, when you hear AI, it's still a lot of it is just data analytics. To train an actual machine learning algorithm, artificial intelligence algorithm, is a significant amount of work, and we're still early enough in the process that a lot of these things aren't fully that. It's more really data analytics, and that's the important thing. And as Richard was mentioning, you don't, as financial institutions, get a lot of truth data. You raise an STR, you raise a SAR to an FIU, to a regulator, and you don't normally get back the results to do so. You can't tweak your models based on whether or not you found actual risk. When you and I were chatting before, the example I used is a seismologist, right? If you use a seismograph, but you don't know whether, and you're trying to predict earthquakes, but you don't know whether an earthquake in the end actually occurred or not, the analysis that you did, the data that you're using is sort of, it's sort of pointless because you don't end up there. So what the conversations that we end up having, not to beat the needle in a haystack analogy to death, but what we're trying to do is not make it necessarily, making it necessarily easier to find the needle, not making the needles bigger per se, but trying to make that haystack smaller. By trying to reduce the false positives, that means that the number of alerts that you have that are actual risk will increase as a percentage of the total number of alerts. So by getting less alerts, by your nature, you're potentially finding more risk.
And no, I mean some great points by Richard and Doug there. Data is key at the end of the day, and most large banks, they have a challenge around the quality of the data that they hold around their customers and the transactions and how that gets fed into the transaction monitoring systems. And most TM systems are garbage in, garbage out. And when you have AI, ML models that are reliant upon garbage data, then the results may not be quite what you expect, and actually they can become worse over time because you've got bad data that is kind of retraining the model badly, I should say. Mm-hmm. This is one of the challenges. So we're looking at several areas here. One area is, can we use AI machine learning to be able to detect financial crime more accurately and more quickly than traditional rules-based TM models? But also, when it comes to finding the proverbial needle in the haystack, can we also sift through the data that we have, the false positives, and try and find out risk that maybe we haven't picked up, or if it's been discounted by ops, for example. But more importantly, identify the higher risk transactions and prioritize them, get more contextual data around them, maybe like KYC information, transaction history, things like that, so that when you present that data to operations, they can work the investigation much more effectively. And I think, as was also mentioned, one of the big challenges that we have is that lack of feedback from law enforcement when an STR or a SAR is raised. A lot of the time you don't know whether something that you flagged as suspicious was actually really suspicious. Only if it leads to a customer exit will you know at times, but there are also many occasions whereby you wouldn't know and the customer wouldn't be exited.
If besides that this is money laundering, you found it with your transaction monitoring, but we want to monitor it to see who they're in, you're not going to know for an extended period of time that there's actual real risk there. And I think that that's the problem. It's not that the data is garbage, because the data is what it is, but it's just without results, you don't know whether your theory is correct.
Yeah, I was just going to say we have another quick poll, and this is really just to get a sense of how many institutions might be implementing AI and machine learning. So if we can put that poll up, does your institution use AI or machine learning in conjunction with transaction monitoring? Yes, no, or working on it. So we'll please whoever's listening in, please try to answer the poll, and we'll revisit the responses later. But I guess while we're on this topic of AI and machine learning, I want to get a sense of the sort of and there might not be a clear answer on this, but a sort of sense of the regulatory expectation for using these types of technologies in your transaction monitoring system. For one, just as a preface, it sounds to me like it's sort of two chains of command. One is the regulator basically giving you these rules, telling you have to look for these rules specifically. And it sounds to me like the AI and machine learning aspect is sort of more from a bank's perspective, more of an operational issue, trying to more effectively do that risk assessment. But with all these false positives, you kind of have to find a way to reduce the sort of, I guess, garbage that you have to sort of investigate. I don't know if my view on that is correct, or if you have different perspective.
I think from a regulatory point of view, the expectations are just actually changing. Probably you see originally, I guess, as it's traditionally done, a regulator would come into a targeted review on a bank's transaction monitoring, capability, and they would sort of just tick the box that it's in place. They have policies, procedures, they have things signed off. But the one thing that they sort of never really had an issue with was the fact that 95% false positives. So, and your folks aren't likely to have time to probably properly investigate something that's there. And that's always been, I guess, a big criticism across the industry. But now that's sort of changing, and you're starting to see the fact that some of the regulators are actually starting to mandate topologies. I know in the capital market space, probably a lot of banks didn't even think money laundering through capital markets was much of a concern, because they always dealt with large regulated markets. They dealt with large players. But it turns out when you see, the money laundering problems and things that had made the news, that's not the case. So the FCA had actually spoken to a number of banks in the UK and realized, well, not a lot of folks are doing anything in this space. And so that led them to start saying, well, here's some topologies. Here's 7 topologies, and we would really like it as a kind of a guidance, helpful hint that you'd be able to detect these. And so it's, as with a lot of sort of helpful guidance, it usually means you should do something about it, because when they come around again, they may actually check it. And these are things that you are very difficult to detect with traditional transaction monitoring. Now you've got to throw in trade surveillance with the transactions and put it all together and use, and they start recommending that you now have to use data analytics to be able to put this together. And so now that means banks are all of a sudden thinking, well, so we can't use our traditional rules-based stuff. We have to come up with something else. That's going to have a big change. Australia is another good example, because the regulator there has actually been putting out topologies that banks are expected to know, and they've been doing this for quite some time. It's a big problem for Westpac getting hit on the payments related to pedophiles going to the Philippines, for instance. The reason why ASIC and the regulators actually came down on them so hard there in AUSTRAC was because they have been given those types of topologies and were expected to demonstrate this, and they didn't. And so I think that's sort of what's going to happen going forward in the future. A lot of banks are realizing they're going to have to start meeting these topology requirements.
So I understand, Richard, that's something relatively new, right? For a regulator to sort of tell a financial institution, here's the typology. This is specifically what you need to detect. Are there other jurisdictions that are sort of doing something similar as the UK?
Well, so far there's, I'd imagine, other than the UK and Australia, others are heading in that direction. I've heard of kind of whispers from various regulators. Can't really go into it. That's something they're looking at. The other approach that some of the regulators are looking to go for as well is to take in a sample of the transaction data from a bank and run it past their own scenarios, and then see if they come up with something different. And if so, if there's anything that the bank has missed, then that's going to be a problem. So that's sort of an approach that's being discussed and may be coming out soon if it's not already there in some jurisdictions.
Lee, you were mentioning earlier about a sort of a lack of feedback from law enforcement or regulators. I wonder how that fits into this as well. If they might over time start demanding banks sort of use the topologies to in their transaction monitoring systems. I assume there's significant feedback mechanism that's needed to sort of operationalize that, is there?
Not necessarily to operationalize, I don't think, but maybe to improve, continuous improvement, right? So, the typology would generally be, you need to look for this kind of activity because this could be representative of, for example, people trafficking, right? And then you have to come up with, a way to implement that within the TM systems. And that's when you get your data scientists, et cetera, involved. Obviously, the way to improve those scenarios is through feedback from the regulators. So, if we were to get more feedback, then that would certainly help. I think, one thing that Richard mentioned earlier in the chat as well was around maybe cross-jurisdictional sharing and cross-bank sharing of data as well, because a lot of the smart criminals, they are unlikely to put all of their criminal activity through one bank, one kind of activity. They tend to understand how rules-based TM works. They react quickly, and therefore if we could have more emphasis on sharing data amongst banks and potentially across jurisdictions, then that would have huge benefits, I think, for the financial crime compliance industry as a whole.
So I think this fits into what Richard was saying as well about the public-private partnerships. Sorry, Douglas, you wanted to say something?
Just going to add to that's exactly the case. I mean, if you take human trafficking as an example, right, and you look at in some jurisdictions where, say, there are massage parlors that are doing 3 o'clock in the morning. This is the normal behavior for those massage parlors. That's a typology, right? Look for transactions that occur outside of the normal hours that you would expect them. And it's not saying look for this exact amount, this, that, and the other. It allows you to look for a behavior that's different than what's expected. Now, criminals can change their behavior. They can take all the money. They can potentially, deposit it in the morning in the bank. Do it all as one lump sum transaction. But then again, you're able to, as Lee was saying, you're able to look at the actual behavior that you're seeing and change the way that you look at it, right? And you change the way that you're monitoring for it. In terms of the sort of private-public partnership and also in terms of banks sharing, we do work with a number of banks in the UK who are able to share that information. And the information is, it can be anonymized or it can be also in the clear, depending on the organizations that are involved. And they have begun sharing financial crime compliance, muling, fraud type information, so that if I see part of the mule network, and you see part of the mule network, then we can put that information together and we can stop the whole thing. And it's, as Lee was saying, it is difficult because across jurisdictions, it's problematic, sharing data, but we've seen it be successful in a single jurisdiction in the UK. So, our hope and our expectation is, as we speak to regulators across the region, that when we show them the data, we show them how it's working, we show them how these banks are finding more financial crime, that this is a possibility. This data sharing is a possibility. Of course, limited only to financial crime compliance, fraud, and the like.
Takes you to the whole point. Is it optimal to expect the banking industry to actually find complex transnational organized crime and how the money laundering flows through that? Probably not, because a bank can only see what these people deal with the bank, as basically as what Lee was referring to. It's going to go through multiple banks and multiple jurisdictions. So is a public-private partnership is probably one of the few ways that you can actually see that. So maybe for the benefit of everybody who doesn't know how the current public-private partnerships operate, I can just sort of mention that one. If you take a look, I think the first one was the Joint Money Laundering Intelligence Task Force in the UK. In that one, you have the National FIU, which is the National Crime Agency, acting as kind of an umbrella. You've got the regulator, the FCA, at the table, and you have a number of financial institutions. Now, the NCA, I guess under the legislation that they have there, can ask all the banks, here's a suspect, here's a terrorist, everybody give me some bank data if you've got this guy in your books. And then they can start piecing together the movement across multiple banks. That helps them out. And now you've got that a similar organization in other countries too. So we've got the Fintel Alliance in Australia. We've got ASIP in Singapore, and FIMLIT in Hong Kong. There's another in the Netherlands, and one in the US that's up and coming too. But the problem that they face is these are all national projects. So you can only see what's happening within the context of that one country. Once it crosses the border, then you need to be able to plug into another national public-private partnership who's got similar data. Until that happens, you're a little bit stuck. But they're moving in the right direction by trying to perfect the public-private partnership. Next step is to make it global.
And I assume, so there should be, I assume, a lot of challenges with just the data sharing in general. Even if it's at the national level, there might be some challenges, given data privacy regimes. But going beyond that, I was kind of also, with regards to the data sharing aspect, I was wondering maybe how an organization like HSBC might operate. Say you have a client, that maybe has accounts in multiple jurisdictions. Are you able to sort of match up that activity between the different jurisdictions where you have operations?
In general, yes. So if you look at data sharing regulations throughout the world, there do tend to be provisions to be able to share certain types of data for financial crime reasons. Obviously, it's a different story if you're talking about marketing and things like that. And it is only certain types of information that can be shared. Now, there are always some outliers. So you do have some countries, particularly here in Asia, actually, where there are restrictions around what data can be shared, who can access that data, and where that data can be located. So, as I said, in general, we are able to do that with a couple of exceptions. Now, I guess our greatest concern right now is that obviously we're living in strange times with a lot of the geopolitical situation that's going on around the world. And I think we've made great progress throughout the world in the last year or two. And the advent of cloud computing has really helped with this in terms of being able to share data overseas for compliance reasons. And I just hope that we don't see that regress through the current difficulties that we're seeing around the world.
Data privacy and cloud computing are the number one and number two subjects that we discuss with regulators every time we speak to regulators, because the thing that we want to make clear, because we see it when we're speaking to banks, we see it when we're speaking to organizations that are trying to fight financial crime, is that these criminal organizations are global, at least regional, right? And so they have the ability to operate however they want. If we can't share data in the same places, then we're never going to be able to stay a step ahead of them. We're never even going to be able to pull up evenly with them. And I think that this is the problem, and this is the point that we try to discuss, is that sharing data allows for better risk management, better risk monitoring, and coming to better conclusions about the risk that we might be finding.
So we're pretty much just about out of time, but I maybe wanted to give you each maybe 30 seconds if you can, just to kind of leave your final thoughts, maybe expectations for transaction monitoring in the next 12 months, 2 years, and so on. Let's start with you, Richard.
I think transaction monitoring, it's got to become it's got to be able to detect a lot more complexity, given the nature of the of financial crime being complex beast. I think the important thing here is being able to take in multiple data sources, being able to run analytics, and then being able to see what is truly behind the transaction that you have. And the other thing is that the public sector needs to provide some of the information that they have on potential criminals to add to your data set, so then you can have a much greater cross-border view of things.
Douglas?
Sure. I guess the key point that I'd like to get across for everybody who's joined us today is, number one, rules-based transaction monitoring is already outdated. The criminals know the rules. Even when the rules are changed, they have to be published. And so they're aware of them. Either way, they can get them. And so monitoring by rules is outdated. Quite frankly, artificial intelligence, machine learning, transaction monitoring alone is probably still not enough, because as Richard mentioned, we don't always get the data to prove whether or not there was actual crime there. And so to just be looking at the transactions themselves probably doesn't get you all the way to that point of stopping crime. It's combining that transaction monitoring with other attributes like location, behavior, where they are, how many accounts do they control that you can see, what are they doing digitally when they're online. Once you combine all of that information with the transactions, then you're going to start to see where the risk and where the crime is. It's more than just the transaction monitoring and looking at the transactions on their own.
Thank you, Douglas. And Lee?
So, no, thank you. No, we live in challenging but exciting times right now. So I think, COVID, although it's caused many problems around the world, it's also given us a great opportunity, because what we've seen is that customers have moved to digital channels much more quickly than they maybe would have done without COVID. And that gives the opportunity to be able to get access to a huge amounts of data about customer behavior, spending patterns, transactions, who they transact with, etc., etc. All this kind of data now with the advent of cloud computing means that there's the potential capability to be able to run very complex analytical models over that data to be able to identify financial crime that maybe we're not identifying through traditional rules-based systems right now. In order for that to really play out, we do need to see more progress in terms of data sharing, not just across jurisdictions but across banks, etc. But there's very exciting potential for that technology, in my opinion. I think in line with what Douglas and Richard have said, AI as a tool on its own to find financial crime is probably not quite there yet. That doesn't mean to say it won't get there. So I think that we'll potentially find a bit of approach in the future with rules and analytics-based models on top. But yeah, it's really exciting times, I think.
Well, as you mentioned that, that last poll that we ran, does your institution use AI or machine learning in conjunction with transaction monitoring? 26% yes, 44% no, and 30% say working on it. So some interesting results to leave everyone with. So we are out of time at the moment. We would have loved to maybe spend another hour with you guys. But yeah, we've talked about some of the challenges of rules-based transaction monitoring systems, how banks are now leveraging some of these new tools, AI, machine learning, data analytics. I would like to thank our panelists, Lee Ashmore from HSBC, Richard Carrick at Crime Stoppers International Asia, and Douglas Wolfson from LexisNexis Risk Solutions. Very interesting discussion. Thank you so much. For the audience to keep in mind, Douglas will be on again towards the end of the day to talk about digital identity. So if you join that.